Have you ever thought of borrowing to invest? Making the banks working for you on top of the stock market and making money on others people's money? Well, that's what I'm trying to do with the Smith Manoeuvre plan, which I started last year. And today we're going to go deep inside my portfolio and see what happened over the past 12 months. Dividend Gold investors, bonjour. My name is Mike Roux. I'm the founder of Dividend Stocks Rock, and I'm also a passionate investor where I help you invest with more conviction so you can enjoy your retirement. And speaking of retirement, my goal is to build a larger portfolio so I can definitely enjoy that lifestyle when I'm getting older. So the principle here for the Smith Manoeuvre, if you're not familiar with, is for Canadian, because in Canada we're not as lucky as you Americans, where the interest we pay on the mortgage is not tax deductible. So there's a way to make it happen and transfer it. So instead of like paying capital on my mortgage, what I do is every single time I put $500 in capital on my mortgage, I take $500 away from my line of credit that is attached to the property. So the ELOC, home equity line of credit, and I invest that money. So whatever interest I pay on the ELOC is then tax deductible against what I am generating from that portfolio. So now, without further ado, let's go inside Dividend Stocks Rock and see my portfolio for the Smith Manoeuvre after a full year of being invested. So here we are on a beta dashboard I'm working on for my Dividend Stocks Rock member. That's gonna come out actually in September. I'm super excited about it, but I decided to create my Smith Manoeuvre portfolio inside of that beta phase just to show you what it looks like. So right now I have almost $6,000 invested in this particular portfolio. I'm on margin for about $1,000 right now. So the real value is like 4,900 and then and not 59. The reason why I decided to use a little bit of margin on this one was to just push that strategy forward when I see great opportunity. The other reason why I did that was I took a break of a few months where after I came back from Africa last year, I was a bit tight with my budget. And one very important lesson when you borrow to invest is to make sure that you're always in a solid financial situation. If you are not in that kind of situation, well, it's better to hold back for a few months, making sure that your budget is getting more comfortable, and then you can move forward. And this is what I did. So I took a few months break. Now I'm back putting that $500 every month. So every month I'm adding a new stock to my portfolio. So far over roughly a year, my gain are 4.5%, so it's not incredible, but it's not the end of the world either. And I have a dividend yield of 4.67, which is lower than the interest I pay, which I pay a little bit more than 6% right now on my ELOC. So at this point, after a full year in terms of just dollar amounts, I am losing a little bit of money on this one. So now we're gonna look into the allocation to see what it looks like. You have, obviously, it's 100% equity, 100% Canadian, but what is important here is as I build my portfolio, I'm trying to get some kind of diversification. So as you can see, I'm really heavy on financial with 39% of my portfolio in it. After that comes communication services at 16. We're gonna see that in a moment what it is. And then I have materials and pretty much all the other one like consumer discretionary, energy, 7, 8, 9%, industrial, and utilities. On the right side here, I see the total amount that is invested in the stock. So we have TD, that is my largest holding at $1,100. We have Great West Life at 650, and then we have National Bank. So we have three companies, one that I use a $500 margin to boost my return that was in TD because they are facing a lot of challenges with the regional bank collapse in the US. I shouldn't say collapse because there's only a few regional banks, but there's a lot of concerns around that. So that kind of like helped creating an opportunity. Obviously, I need to be a little patient on this one, but so far I'm very happy of what I've done. Now moving on to the communication services, we have TELUS that is almost at $1,000, which is there. The reason why I doubled down and I bought twice $500 each TELUS, well, right now it's trading around like 25 bucks. It's just like a crazy amount. The company has so many different growth vectors, working with AI, having the 5G being developed, and they're generating more and more cash flow, which I kind of like, because now they're getting to a point where they can almost finance all their capital expenditure, meaning that all their new projects that they're going to use fund for, they can finance it from their cash flow almost 100%. So it's not there yet, but it's getting there. I bought Brookfield Infrastructure for 500 bucks. This one is like a utility, ETF utility, where they operate across the world. They have multiple different business segments. So we're talking about toll roads, ports, gas storage and transmission pipelines, electricity transmission, data centers, name it. They're like invested in all kind of different utilities, which I love, because then you are backed with a strong business that is Brookfield, and this one is really specific on all different kind of utilities. On the industrial side, I have Exchange Income, small business that is like very fascinating. It's like it's a small yield, small cap company, where part of that business is all about manufacturing. So they're growing through acquisition, and it's relatively stable throughout the years. And then you have the aviation business. So two different type of businesses inside the same one, which is a small cap. So fascinating stock, very good yield, and they went through the COVID without cutting their dividend, which is a big feat in the aviation business. I'm pretty sure you know about that. One of my latest add-in was Nutrien, NTR.TO, another 500 bucks over there. I bought this one not long ago, I think at the beginning of June, if I remember correctly. I'm very excited about Nutrien going forward. I'm not a big fan of commodity-related stocks in general, but what is really interesting about Nutrien is when you buy it at a very low price, your chances of making a good profit increase. Now this year they got hurt by lower commodity prices, and on top of that they issued weak guidance. So all of that put together, very bad narrative. So right now I'm pretty sure we're getting close to the bottom of this. So hopefully we are at the bottom and it's going to go up. But for me, it was a good educated guess. In the consumer discretionary, I decided to buy Canadian Tire. Canadian Tire because they have an iconic brand in Canada. They pay a generous yield. They are most likely recession-proof resistant. They can also go and be a e-commerce proof business model, because they own about 45% of their brands that they're selling. That means nobody can sell Motormaster or Mastercraft brands and all the others that they own, and they have this like discount way of like offering like always a great rebates and stuff like to Canadians. So even during a recession, they will likely try to find a way to cut down on expenses. They're gonna go to Canadian Tire. And the last but not the least, that was a protection against the crazy oil market. That was like one of my first add-on. Canadian Natural Resources, 500 bucks, that is currently negative because the oil market is not doing that great anymore over the past 12 months, unfortunately. The reason why I bought it, well, great dividend, but on top of that, they have been able to increase their dividend for more than 20 years. So that means that regardless is going like what's going on with the oil market, if it's going up or it's going down, they keep the pace, they continue to increase it because they're sitting on incredibly low value, low cost production, so they can produce at a very low cost their oil. So whenever the oil barrel price goes down, they slow down production, and when it goes back up, they ramp it up and they make a lot of profit. So now moving on here for the dividend forecast, what is interesting is I know which month I'm going to get money, and I know exactly which date as well, which is quite interesting. The overall portfolio, I have a weighted pro rating of 4.22, which means it's pretty solid in terms of the dividend triangle and all the fundamental analysis that we have on our team. Obviously, you cannot trade based on rating. That would not be a good and smart idea, but it gives you an indicator of the health of your portfolio. And if I ever had companies that falls down into ratings, then I know that I have to put a little bit more attention to this one. In terms of dividend safety, we're pretty much in line as well. We're pretty much close to 4, obviously with higher paying yield, because I'm trying to pick companies with a yield that is above 4%, especially because my interest rate is now at 6. So technically I'm still in the red for that. I need to get some total returns to compensate for it. So having a balance between dividend growth and a high yield is not an easy thing, but when I look at the average 5 years of my dividend growth, we're at 8.6, which is pretty strong. And over the next 12 months, I should get roughly $300 in dividends. So that's the forecasted dividend payment. So currently what I have in dividend times 8.6%. This is what's happening. So I hopefully going to get there. Now I have like all the stocks that I've discussed today. So if you're if you're curious about the company or the ticker, just wanted to show you here what it looks like in terms of yield. As you can see, most of them are paying above 4%. I have Brookfield Infrastructure and Nutrient that are slightly under 4, but that is also a point where I'm trying to focus on high quality businesses. So I'm not going to go only for high yield, but I want to have a good balance between the dividend triangle and the yield. Now, if you're looking for other stock buy ideas, you can download the Rockstar list. The Rockstar list is a list where we track Canadian and US stocks. We update it monthly. So as soon as you register to our newsletter, you're going to receive it every single month, which is pretty cool because metrics and the market change all the time. And this is what I use to find my next pick for the Smith Manoeuvre. So you'll have a bunch of different metrics there. You can filter by dividend growth or by dividend yield or whatever you're looking for, but all of those companies shows a solid dividend triangle, meaning that over the past 5 years, revenue, earnings per share, and dividend has been positive. So it's a great start, obviously not buyer stock recommendation, but definitely a great start to look into what's interesting for you. So, all right, that's enough for today. If you have any questions about the Smith Manoeuvre, about my portfolio building, I'm going to look forward in the comments to answer them. And until the next video on the next Thursday, don't forget to stay invested.